presentation after the session today. So you'll all be receiving that. And there also will be time for question and answer at the end of the session. I know Tom and Katrina have said that they're able to stay. So we'll make sure that we get all of your questions answered, even if that means running a little bit over time. We'll see how we do with time today. I think that's all of the housekeeping. So with that, I will over to today's presenters, Tom and Katrina from Whittlesey. Whittlesey is one of the largest CPA and IT consulting firms in New England, and they also happen to be a member of our Alliance Allies program. Our Alliance Allies are business partners who are experienced working with nonprofits, understand the unique needs of nonprofits and the challenges that all of you face, and they love to work with our members and offer discounted goods and services to help you to strengthen your organization's infrastructure and your internal capabilities. So if at any point you feel that Whittlesey can be of assistance to you and your organization, please reach out to them, let them know that you're a member of the Alliance. And we have additional allies as well on our website if you'd like to see kind of who's part of that program. And I think with that, I will hand it over to Tom and Katrina. Thanks so much for doing this for us today.
Well, thank you, Allison. And we're excited to have such a big group today. Clearly, this is a topic that's resonating. Tom, can you just confirm you can see the screen?
I can see, yes.
Okay.
I want to thank Allison for pronouncing our firm name correctly.
Right, yes.
We've heard every iteration, so thank you.
Yes. Yeah, it's not the easiest name to pronounce, admittedly. It's Whittlesey. We got a lot of Whittlesleys. But yes, we have been growing over the years. Tom and I will just give a brief intro about ourselves. Both Tom and I have spent our careers with Whittlesey. I've got over 20 years of experience in nonprofits. Nonprofit is my practice concentration. And this is, grants, this is definitely my wheelhouse where I've spent my career. Tom, do you want to take it away for your?
Yeah, like Katrina, I spend 99% of my time with nonprofit organizations. I've been with Whittlesey for over 16 years now, working with the niche. So I've seen it all as well. So.
And let me just mention our email addresses are on the screen. So if you want to take down our email, and it's on the website as well, so you can certainly go straight to the Whittlesey website and we're on there. So feel free to reach out to us after this presentation if you have any other questions that we can help you with. So we do have a lot to cover today. As we mentioned in the emails you're getting about the topics we're going to cover, we want to cover a variety of topics over grant management. So revenue recognition, financial statement presentation, cost allocation plans, internal controls, audit preparedness, and compliance testing, and then finally the grant closeout procedures. So we're going to cover a lot of topics in a short amount of time, but we hope that, everyone, whether you're in a larger organization or smaller, or if you're brand new to grants, or if you're, you've been dealing with this for years, we hope that everyone can take away a little something. And we would encourage you during the presentation, if you have something you'd like to share or some input for the other attendees, maybe you have a best practice that you want to share, I'd say feel free to put that in the chat. The chat doesn't just have to be for questions. If you'd like to share a little bit of your own tips and tricks with the other attendees, I'd encourage you to do that as well. All right, I think with that, I'm going to turn it to Tom. Tom's going to cover the first few topics.
Okay, so we just want to kind of start with a little polling question. I'm just wondering, how confident is the group with their understanding of revenue recognition as it relates to grant accounting? And maybe just type it in the chat. We can kind of see, get a baseline here.
See a few thumbs up there.
Yeah. All right. Okay, perfect. So if we have any questions, we're going to go to you, Rita, and Emily. So we're going to start off with some learning objectives. And this first section is really just an overview of revenue recognition. Hopefully it's a good refresher of ASC 958 to 605. So we'll start off with the difference between reciprocal transactions and non-reciprocal, and then move down to the difference between conditional and unconditional contributions. And from there, whether or not those contributions have donor restrictions or no donor restrictions. So we'll begin with the very, very basic, and we're kind of going through a decision tree, and we'll have a few examples. So first, we're going to begin with is it an exchange transaction, reciprocal versus non-reciprocal? And that really comes down to, well, who is receiving the benefit? Is it the resource provider? Is it the general public? That is the main question. So if it is the resource provider, again, that would be reciprocal. Fair value is being traded for benefits, as opposed to something for the general public that might indicate just a regular grant. And the example that I like to use is actually the alliance itself. It has many programs, and one of them is providing, amongst others, janitorial services to several state agencies. So when you look at the actual janitorial services, well, that is reciprocal because these state funding agencies are actually getting their offices cleaned. Now, if the alliance here got an actual grant, that would be non-reciprocal. So there is a bit of a distinction. So moving on to the next decision is, well, okay, is we have a conditional grant or an unconditional grant? And again, there are two things, and it's an and, not an or. So in order for a transaction to be a conditional contribution, you need a right of return as well as barriers. If you just have one, then it does not meet that criteria. You would have an unconditional contribution. So moving on to the next slide, we'll get into, well, what is an actual barrier? And this is where you really need to take a look at your contract, grant agreement, donor agreement, etc. To really determine, okay, is this a barrier or is it something lesser, which could just be a donor stipulation? So there are three main ones that we take a look at. The first is a measure of performance related barrier. So that could include a specified level of service, an identified number of units of output, or a specified outcome. The next one relates to the limited discretion of the recipient to conduct that activity or spend that money. So we really want to think of qualified expenses, reimbursed cost grants. And then the last one relates to the extent which the stipulation is related to the purpose of the agreement. So a good example would be if an organization is required to produce some sort of research report at the end of a grant. Now that would be different than, say, an administration report or a summary report, which is clearly trivial, which would not indicate a barrier. So we're going to have a little knowledge test right here. We'll start off with example one, which is a local government provided funding to a nonprofit to perform a research study on the benefits of a longer school year. The agreement requires the nonprofit to plan the study, perform the research, and summarize and submit the research to the local government, which retains all the rights to the study. So maybe we'll just do a quick show of hands in the reaction. If you think that it is reciprocal, we'll start with the clap. And if you think it's non-reciprocal, just put up a thumbs up. Let's see if everyone's paying attention. I see a clap.
See at least one thumbs up.
All right, so we're going to go with The answer being reciprocal. And again, at the end of the day, who is benefiting from this? Is it the general public or is it the local government, which would have to perform these services on their own? In that case, because the government is retaining all the rights to the study, they're the ones that are getting the benefit. All right, moving on to example 2, nonprofit B. We're very creative with our names, is a public charity that performs research on various diseases, allergies, including gluten-related allergies as part of its overall mission. It receives a $100,000 grant from a foundation to perform research on gluten-related allergies over the next year. The grant agreement includes a right of return as part of the foundation's standard wording and requirement at the end of the grant period must be filed with the foundation that explains how the assets were spent. And I think that is the key delineation there. So even though you do have a right of return, that last one there is not related to the actual stipulation. It's not program related, it's just trivial administrative report. So in that case, we would have a donor restricted contribution. And then finally, looking at example 3, a nonprofit operates as a homeless shelter that provides individuals with temporary accommodations, meals, and counseling. The nonprofit receives an upfront grant of $75,000 from the city for its meals program. The grant requires nonprofit C to use the assets to provide at least 5,000 meals to the homeless. The grant contains a right of return for meals not served. So again, we do have a specified level of service, a specified outcome, as well as a right of return. So that would be a conditional contribution.
Tom, sorry to interrupt. There's a question in the chat that's just asking why these classifications of reciprocal and conditional matter.
So this matters because it all depends on how these are recorded on your financial statements. In addition, if this is state or federal funding, that will have an impact on whether or not it's recorded on your CFA or SESFA, which could trigger you for a single audit. And I know that Katrina is going to get into that in a little bit. Okay. Got a few more examples where we've got the Connecticut Community Loan Fund as a nonprofit lender, awarded a grant from the Department of the Treasury to give loans to small businesses owners who meet specific criteria. The agreement requires CCLF to follow rules and regulations established by the OMB, incur certain expenses in compliance with those standards, and then submit a detailed demographic and financial report. There's also any unused assets are forfeited and unallowed costs will not be refunded. So if we go to the next slide, we can see that that would be a conditional contribution. Because there is no commensurate value being exchanged. The beneficiary is the small business owners and not the Department of the Treasury. So again, that goes to the general public. We do have some barriers as well as a right of return. Okay, we'll do one more. Our veterans receives a grant from a private foundation for funding in the amount of $400,000 for specific career training. The grant provides training to at least 8,000 disabled veterans during the next fiscal year with specific minimum targets that must be met each quarter. And then we have a right of release from the obligation in the agreement in the event that WHOV fails to meet the targets in any given quarter. So we would have, again, it's a contribution. There's no commensurate value. It is conditional because you do have barriers and a right of return. And it is restricted because it's more of a narrow focus than the overall mission. Okay.
I
I
might
think
just add, based on that question the other individual had, this is when Tom and I are performing audits, this is one of the most common problem areas where a finance department might struggle with how to recognize the revenue appropriately. So this is an area where we commonly end up having auditor adjustments or findings. So it is so important that the accounting and finance team read these contracts, understand the requirements, and that will result in the correct revenue recognition, the timing of the revenue recognition.
All right, so for our next section, we're going to go over how we actually record these on the financial statements. So we're going to look at the three different types of transactions: exchange, conditional contributions, and then unconditional contributions, as well as go over a few disclosure considerations too. So this will help you when preparing your financial statements, get fewer audit adjustments, and make your single audit go a little smoother, hopefully. So we will start off with the reciprocal transactions. Again, this would be considered program revenue. So it's not a government grant, it's not a contribution. It'll be under, in this example here, professional fees. Again, commensurate value is being exchanged. When you look at the balance sheet, the statement of financial positions, if the amount has been earned but not yet received, that would be recorded to accounts receivable as opposed to grants receivable and promises to give. Katrina mentioned we typically have reclassifications due to errors on this part. And then if you have received the cash upfront but not actually met those performance obligations, you would have deferred income. And again, that's from a terminology perspective different than a refundable advance. So looking at some disclosure considerations, again, the big thing that came out in the last couple of years is revenue recognition. So just having a policy in your footnote that goes over the specific contractual obligations and how that program revenue is actually earned. You also have to disclose the total that you have in trade receivables, as well as deferred income and contract liabilities, which are a little slightly different. But what we've done here is just copied one from the YMCA. We do a lot of YMCAs, and they have various different revenue streams. So again, we use that kind of as a pretty good example that covers the things that you need in that disclosure. So then moving on to conditional contribution. Again, this is going to be your pretty much either say a foundation grant, foundation contribution, government grant. So on the income statement, again, for this situation, we throw that into government grants or contributions. And then on the balance sheet, that would be recorded as either grants receivable or a refundable advance. When we look at the disclosures, again, many of these, especially with state and federal grants, depending on your fiscal year compared to your calendar year, you could have multi-year commitments. So if you do have a grant that's going to span multiple years, one of the disclosure requirements is to, again, note the amount of the remaining grant that could be recognized. That's basically if you have a $1 million grant and you've only spent $200,000, regardless of whether or not you received the cash, it's sitting in deferred, sitting in refundable advance. You have $1 million, you've only earned 200, you've got $800,000 left to be recognized in future years. So we've included a little sentence that we see in most of our clients that have state and federal grants. And then lastly, we'll move on to unconditional contributions. And again, that'll be either with donor restrictions or without donor restrictions. Any receivable would be considered a promise to give. Again, for the disclosure requirements, there are several. It goes into the different classes of net assets. So again, that could be broken down or designated as opposed to with donor restrictions, and then with donor restrictions, maybe the various programs that you run. In addition, you need to break down contributions and releases by class. There's typically a footnote as well. So I think with that, Katrina, we're running 4 minutes behind. But any questions on the actual recognition or how to record it on your financial statements? I think we do have a question. So in the $1 million example, all revenue need to be recognized when the award is received. In that case, no. It depends. Again, is it a conditional contribution or unconditional contribution? So that is in that example, a conditional. Katrina, you want to go back one more?
This one, yeah.
Yeah, this one. So again, that's just, you would not record that. Again, you're going to record the grant revenue as you actually expend it for most reimbursed cost grants. So in that case, you would only recognize, say, that $200,000 we talked about, as opposed to the total 1 million. Does that answer the question? So this is just a footnote that indicates how much more is left on the grant award.
Yeah, this is a common problem area, as Tom mentioned. So, when we're coming in at the end to perform the audit, it can have ramifications to the single audit, to the financial statements. It's just so important to focus on the revenue recognition. So we don't want to record grants on a cash basis. And I know the terminology here may be throwing a few folks off. So in GAAP, generally accepted accounting principles, they don't use the terminology grant. So you follow the conditional contribution guidance. And I know that's kind of a mental block for people. You don't think of a grant being a contribution, but under accounting rules, that's the guidance we follow for revenue recognition. So I'd say 9 times out of 10, the type of grants we see, you should be matching your revenue to your expense because it's more of a cost reimbursement situation. So like if you got $1 million in, but you've only expended 500,000, you should only be recognizing revenue of 500,000 for that year.
Yeah, and again, for this footnote, you'd have to disclose that there is another $500,000 remaining that could be spent in the future. And this is, again, when we're helping our clients to prepare financial statements and footnotes, more often than not, when we, again, go over the draft with the client, they'll ask, oh, where did this number come from? And the answer, it should be tracked on your grant schedule. And Katrina, I think you might be going over an example, but there should be a column for total award and then various columns depending on the years for cash received and then actual expenditures, which is going to equal the revenue that's recognized.
All right, I'm going to continue. I guess, Tom, just please let me know if you see any questions or feel free to interrupt me. So moving into cost allocation plans. So if you have a state or federal grant, you need to have a written cost allocation plan. We'll talk about the state of Connecticut first. So the state of Connecticut Office of Policy and Management has cost accounting standards. I did put you can actually just go out to Google and easily find it. But I'd encourage you to look this up during our conversation now if you're not familiar with the cost accounting standards. But it is required that you have a plan that is designed in accordance with OPM's cost accounting standards and that the plan is to be approved by the governing board. So the purpose of this plan is to summarize in writing. So this is a key point that it does have to be in writing, the methods and procedures your organization uses to allocate costs across programs. So only costs that are allowable in accordance with the cost standards should be allocated to a state award. And your cost allocation plan has to include provisions for allocating these different categories. So direct costs, administrative and general costs, and salaries and wages. And as I mentioned, the plan does need to be approved by your board of directors. Likewise, on the federal front, and I'll just stop here to kind of mention another common problem I find. So if you may have a grant from the state of Connecticut, but the state is funding or either fully funding or partially funding that grant with federal dollars. And if that's the case, you have to know that. So on your single audit, for example, you have to report that as federal expenditures that are passed through the state of Connecticut. So in this case, you are subject, even if you are not receiving a direct award from the federal government, even if it's a pass through the state of Connecticut, you are still responsible to comply with the federal uniform guidance.
Hey, Katrina, how would you know if it's federal as opposed to state?
Usually it is in the grant contract. So you do need to carefully read those grant contracts. The state is responsible to tell you in the grant contract if it's passed through funding. I'll be honest and say that oftentimes I can speak from my own practice. I always send grant confirmations as part of the audit process. And I find that sometimes my clients are finding out that there are federal dollars embedded in their state contracts at that time. So they're not finding that out until audit time. So I would encourage everyone to have a point of contact where they can verify the source of the funding. So I'm just going to touch quickly on a common, everyone, 9 times out of 10, your largest expense is going to be your salaries. So the uniform guidance, here's a couple points that are important. So under the uniform guidance, and I give you the section here that gives the guidance. So supporting the distribution, you have to have written documentation that supports the distribution of an employee's wages among specific activities or cost objectives. And the state of Connecticut has a similar rule that the distribution of salaries and wages must be supported by personnel activity reports. So mostly what I'll see in that instance is people are keeping detailed time records about level of effort. If you're not keeping a daily record, I would caution you that budget estimates alone do not qualify as support for charges to a federal or a state award. So if you're going by budget estimates alone, that's not an allowed method. That being said, there are some different ways that you can track personnel costs. Again, most often, if you don't want to keep detailed timesheets, you can do like a time study, or you have to have some other reasonable method to support your payroll allocation.
I have one more question on that. What about bonuses?
So bonuses, yes, that's a common problem area. Bonuses are not allowed. The state does allow for what they call incentives. But the key there is with an incentive, you have to have documentation saying how that incentive is earned in advance. So technically, bonuses are a disallowed cost. So if we as the auditor came in, look, and we're doing an audit of a major program and we saw that bonuses were included, that might likely be written up as a finding. So some common allocation methods for allocating costs is time and effort, FTEs, so full-time equivalents, or for occupancy, you can use square footage. So this is this is actually a common problem area as well that I wanted to mention today is I see a lot of folks using Excel, for example, to track costs or allocate costs. On the flip side, I'm sure some of you are on the call today, you have a very organized system within your chart of accounts. Maybe you're using, Blackbaud's Financial Edge or MIP. Even if you're using QuickBooks, QuickBooks has classes. So no matter what system you're using, I think you can take advantage of your chart of accounts to capture or more efficiently capture the costs. And I would say the ideal is something like I've outlined here is actually setting up your chart of accounts to include the grant. So you would include every single grant as its own grant code. And if you have multiple sites, you can include a site code or program. And this just makes reporting so much easier. If you capture all this data within your general ledger, it just makes a world of difference with efficiency. You can run reports in real time. It does take some effort if you haven't done this, obviously, to set up a system like this, but I have seen systems such as this set up very effectively, and it just makes the whole reporting process, the audit process, a breeze at the end. So I think it is well worth the time and effort to set up a general ledger system with a robust chart of accounts. All right, I'm gonna skip ahead to audit now, it's internal controls to kind of keep us on track here. So with internal controls, again, this is a requirement. So if, obviously it's a best practice to have solid internal controls. But if your agency is accepting state or federal funding, you are required to have a written documentation about your internal controls. So I'm not going to read all this, but verbatim, but I wanted to show this to you. This is straight out of the federal uniform guidance that is saying exactly what you're required to do as a recipient of federal funding. And the state of Connecticut has essentially the same thing. So you are required to establish and maintain effective internal control over that federal or state award. And they do specifically mention that the internal control should be in compliance with guidance in the specific document, Standards for Internal Control in the federal government, or, and this is what I'm going to show you, the Internal Control Integrated Framework issued by COSO. So, if you've hopefully, some of you are aware of this. If you've never heard of this, it might throw you for a loop a little bit, but I'm going to explain this for you. So you hopefully have a little better understanding of what that means. And again, this is important because when we come in to perform your single audit, these are some of the questions we're going to be asking you. So what the federal and state government are looking for is that you have a system of internal controls in accordance with, I'll call it COSO, and you can Google that later. So those 5 components in that framework is the control environment, risk assessment, control activities, information and communication, and monitoring. And I'm going to give you an example of what would be considered a control in each of those areas. So in control environment, a good example would be management sets a reasonable budget and has a formal cost allocation plan. So that would be an example, internal control. With risk assessment, an example would be that management assesses the risk of unallowable activities or costs that could be charged to a program and not be detected. And you should be performing a formal risk assessment process and documenting that. Control activities, that's the one that everyone's familiar with. For example, having adequate segregation of duties between review and authorization of costs. Information and communication. So you want to have training that provides your staff with the knowledge and skills necessary to determine if activities and costs are allowed under your program. And then finally, monitoring. An example of a control would be that management is reviewing budget to actual reports on a timely basis. And that's actually, I've seen, again, when I've seen things go wrong, oftentimes it is because this step is not being performed. So it's so important that the finance team or your accounting department is communicating with the program directors and making sure you're both on the same page so you don't run into any surprises at year end. So for example, what I would consider a surprise would be, maybe there was a grant that didn't get spent down, and the accounting team is realizing this at the end of the year. So if you have those regular budget to actual reports and have your program team review it together with the finance team, that leads to much better outcomes. All right, I'm going to move on to audit. As we mentioned, the materials will be made available to you. So we did actually include additional information in the materials for your future reference. But for today, I'm going to move ahead to the audit section. So when you're preparing for your audit, just a little background or reminder for everyone. So a federal single audit is triggered when you have spent $750,000 or more in federal funds. And as I mentioned earlier, you have to remember the pass-through money. So in many cases, you may have all of your funding through the state of Connecticut. However, if the state is pulling in federal dollars, especially recently, there's been the COVID funding, the ARPA funding, then that is considered federal money and could trigger a federal single audit. For state of Connecticut, the threshold is much lower. At $300,000 or more, triggers a Connecticut state single audit. So something important, this is important for the audit, and it's probably not, I would venture a guess it's not important to you on a daily basis, which I completely understand. But when it comes to audit time, you need to know, you need to be able to identify a federal and state program. And the way you do that is by the ID number. So all federal awards are assigned a federal assistance listing number. So this used to be called a CFDA number. I have a few examples here. So it's always going to be a 5-digit. So the first 2 digits represent the federal agency. So 93 is the Department of Health and Human Services. When you take it all together, 93.558, that's the program called Temporary Assistance for Needy Families, also known as TANF. So another example is 14.235. That's the Department of Housing and Urban Development, so HUD, and that's the Supportive Housing Program. So if you go to sam.gov, you can look up all this information. And this is so important. This is where during the audit time, we spend a lot of effort on this. And the reason for that is because we have to select, our testing is based on those ID numbers. So let's say you have 3 or 4 separate grants, so from your standpoint, they're different programs. But for the purpose of the single audit, they're all funded, let's say it's 93,667, the social services block grant. So we have to look at the grand total of the 93,667 funding, and that's how we determine if we're testing it as a major program. And as you can see, hopefully this is familiar to you, but if you're new to grants, this is a schedule of expenditures of federal awards. So this does get filed within your single audit report. So, and it's very important that you have this data. So including the ID numbers, any pass-through information, the name of the program, this is all critical information for your single audit.
Yeah, and you can get the name of the program off of that sam.gov, because I know those do change from year to year, and what you might have typed on your grant schedule or internal documents might not be updated. That's always a good tool. When I'm looking at a CFA, I'll always go to that website and I'll type in the number just to make sure that the description is the most up to date.
Yeah, and likewise, the state of Connecticut, it's very similar to federal. So in the state, it's a core, they call it the core CT number. And I gave you several examples here. So it's an 18-digit number. The middle section is your agency. So as you can see, Department of Mental Health and Addiction Services, Office of Early Childhood, and Department of Developmental Services are some examples I gave you here. And then the last digits are what I call the SID number, the state ID number, and that identifies the name of the grant. So for example, 16003 is grants for substance use services from Demas. Or 16108 is the employment opportunities and day services from DDS. So this is an example. This is actually the state of Connecticut's example that they provide of a schedule of expenditures of state financial assistance. And again, I'm showing, this core CT number is integral to accurately filling out the schedule. So Tom mentioned a grant schedule. This is so important. I'm going to share, actually, can you see this, Tom, on the screen?
Yeah. Maybe zoom in just a little bit. There we go.
So this is just one example. You know, your grant schedule certainly doesn't need to look exactly like this. This is a smaller example, but you should be preparing, your finance team should be preparing a detailed grant schedule. So this has, your grant name, your ID number, which we just talked about, and then your grant year. And then you provide some other information here. So for example, the payments made, so you're calculating the cash payment, how much you spent, and then an ending receivable or a refundable advance. And this is this schedule feeds into your schedule of expenditures that gets reported on the single audit. It also should reconcile to your revenue, to your grant receivable, to your grant payable. It just brings the whole picture together in one document. And then this last column, let's see if you can see that. So the last column here, we're calculating what is remaining. What usually, most times you have a multi-year grant. Sometimes there's 1 year, but I'm seeing a lot where there's multiple years, maybe 3 years. So the final column can show how much of that commitment is left that hasn't been spent yet. So you can slice and dice your grant schedule however you want, but it's just important that you have these main components.
Whose responsibility is it to maintain that?
So contrary to popular belief, it is the organization's responsibility. I know a lot of folks would like it to be the auditor's job to maintain this, but it is the responsibility of the organization to maintain the grant schedule. All right. And this is, as we mentioned here, if the grant schedule includes errors or omissions, it does result in inefficiencies at audit time. I'm kind of living through this right now, as a matter of fact, where this is a common problem. It's definitely, with the COVID funding, it's made it challenging for everyone. It's good, it's a good problem to have. But for the accountants, there's definitely been some challenges with reconciling and identifying all the various sources of funding. All right, so I'm going to just give you a very high level understanding of what we look at from the single audit standpoint. So when we come in to perform a federal single audit, we are required by the federal government to look at these there's 12 elements of compliance. We don't look at all 12 of these. But I did highlight the more common areas we focus on during a single audit. So I highlight this to, let you know it's important to have this in the back of your mind throughout the year to avoid any issues when it comes to the single audit. So we are looking at things like whether the activities were allowed or unallowed. We're looking and testing allowable costs. Another common one is eligibility. So we may perform tests to see, if program participants were in fact eligible. And then we're always looking at reporting. I would say almost always we're testing that the correct reports were submitted and that they were accurate. For the state of Connecticut, it's the same concept, but there's only 6 areas. So for the state of Connecticut, the areas we would be looking at is, again, activities allowed or unallowed, and then eligibility and reporting are common areas of testing. For some of you, you may have subrecipients. That's not as common, but I do have clients that pass through their grant dollars to other organizations or other nonprofits. So if that's the case, you want to make sure that you are fully aware of those compliance requirements about how you are monitoring your subrecipients and how you are keeping track of all the relevant information. All right, so grant closeout. I know I've been harping on revenue recognition, so this is just a little graphic we have to represent that as a reminder. So your grant reporting should always, the expenditures you're reporting on your grant report should match your financial statements, which should match your single audit. So as you're closing out the grant, you want to make sure you are looking at all those elements, reconciling your grant reporting to your financial statements and to your grant schedule. So as you're closing out the grant, we just have a few things to highlight. Make sure you're reconciling, as I mentioned, look at those discrepancies. Ensure your expenses are all properly accounted for and documented. Make sure you're preparing those financial reports and submitting them timely. Don't forget your programmatic reporting. So 9 times out of 10, you're going to have some kind of programmatic reporting that includes the summaries of the program activities and outcomes. You want to make sure those are completed and submitted to your grantor. If you do have subawards or subcontracts, so for example, passing through your grants to other nonprofits, as I just mentioned, make sure that you're, that you're reconciling that activity and completing all the required reports. So this one is key. So maintaining some open communication with your funder. I've seen that go both ways. I've seen some clients that are kind of hesitant to communicate with their funder, but Honestly, I would recommend having that open communication because, that just avoids a lot of misunderstandings along the way. And then finally, make sure you're keeping all that documentation. That's going to make, if you have organized documentation, if you have a good system of record retention, that's just going to make everything go so much smoother. And then I would encourage you to have kind of a closeout session to review any lessons learned. How can we do things better next time? Let's look for some efficiencies to enhance our process for next time. Tom, do you have you want to take the Q&A?
Yeah, any more questions? I know we've been kind of going through some in the chat, but if there are any others, feel free to throw them in there or just unmute yourself and be happy to answer as best we can.
Yeah, we included a lot of data in the slide deck so that you could use it as a reference. I guess, Tom, interrupt me if you see any questions come in, but we are just seeing some interesting trends in this arena. So some trends we're seeing are just because of staffing challenges that finance teams may be comprised of individuals that have a for-profit background. They have no prior experience with nonprofits. Or we're seeing cases where maybe you do have the nonprofit experience, but you're not accustomed to juggling so many grants. There's just been an influx of a variety of different grants, the ARPA funding, for example, and other special state programs. Just it becomes hard to manage all the different pots of funding that are received. So that is something we're seeing as a trouble area. We're also seeing folks that just aren't aware of some of these regulations. So they all are available online. Make sure to read the fine print of your contract because most likely it does refer to compliance with either the uniform guidance or for your federal grants or the OPM regulations for your state grants.
Okay, Katrina, I think we have a few questions. I think the first one I'm going to start with, we are setting up the slide deck, but how do you determine between TRNA, so that's temporarily restricted net assets, and deferred revenue? So that goes back to the revenue recognition. So we don't call it TRNA anymore. I know we do on some forms, but I think that the technical definition based on the new ASC codification is conditional contribution versus unconditional contribution, and then be with donor restrictions and without donor restrictions. And it's really been difficult in the past couple of years to kind of shed that old terminology for the new. But the difference between, again, a conditional contribution, which would be a grant that would be recorded as a refundable advance, and the TRNA, which would be a unconditional contribution, comes down to, again, you need the two things. You need a right of return as well as a barrier. And the barrier is going to be measurable performance obligation, limited discretion on how it's actually carried out. And then stipulations that are related to the purpose as opposed to just trivial administrative reports. I think we have another one. If a grant can use a service that another department in the agency offers to the public at specific fees, can we charge the grant only the wages for that staff, or can we charge the fee that you would charge the public?
So I've heard that one a few times. So you do have to charge your actual cost. So in other words, if you can't take, you cannot take a profit. I'll phrase it that way.
All right, and then we have one other question. Can you say any more about the common pitfalls for finance folks who are from the for-profit center or profit sector. And again, I think that the biggest one comes down to the revenue recognition and being able to delineate and pick out those barriers. And then beyond that, if there are no barriers or right of return, the different donor stipulations that would put the contribution into with donor restrictions or without donor restrictions. Katrina, feel free to jump in, but I think the other one would be just kind of tracking the grants on a grant schedule.
Right.
And I think following some of those cost standards as well is kind of what we see.
Yeah, you need to read up on the cost standards. The reality, it's not fun, but the reality is you're gonna have to do some homework. In fact, I pulled up, can you see my screen, Tom?
Yeah.
I was moving kind of fast, so I didn't pull up the websites, but I'll just show you here. You can just look up the Code of Federal Regulations. This is what you want to be reading for. If you have a federal grant, everything you need to know is right here. It's called the Uniform Guidance. And then for the state of Connecticut, you guys have access to the same thing we have. So, for example, if we're coming in to perform an audit, we're going to go to the OPM website. We're going to click on this compliance supplement. And that tells you just about all you need to know. And that's not just for us. I want to emphasize, for you as the finance team, I would encourage you to become familiar with this document because it talks about all the things we just covered, like internal controls. It does have the cost standards right here. So OPM cost standards, there's a very detailed list of the types of costs, what's allowed to be charged to a grant, and what's not allowed.
And I think just a few other areas, common areas for people coming from the for-profit sector. Endowments are one, so investments, as well as unconditional promises to give. So there'll be pledges. We see some timing differences or some cutoff issues on when those are actually recorded. Another one would be the allocation of functional expenses and making sure that everything is allocated appropriately in the buckets for program management in general and then fundraising. I think we have maybe one last question, Katrina. If there are grant specific write-offs, wouldn't your grant expenditures be higher than your grant revenue in that case? Now,
You're saying if your grant,
a write-off from, say, the funding agency, right?
I think I was hearing you're saying if your grant expenditures can certainly be higher than your grant revenue. So
not the other way around.
Right. So it's not, I'm not sure if I'm totally following the question, but I think the word write-off is throwing me off, but what you want to think about is the contract ceiling. So let's say you have a $500,000 grant, but your expenditures were higher. So for all of your reporting, you're only going to report up to that $500,000. If your actual costs were higher, and this is the plight of the nonprofits, right? If your costs were higher, unfortunately, you're eating those costs basically, or you're covering it with other types of contributions or other types of revenue. But for purposes of grant revenue recognition and also for purposes of all this reporting that you have to do, for example, on the single audit, you would only report that 500,000 because that's up to the contract ceiling amount. On the flip side, I'm actually seeing cases where folks have a surplus. So a surplus meaning, your grant contract's 500,000, but you only spent, let's say, 450. So if you have that 50,000 that's unspent, that would be like almost like a deferred revenue. So in the nonprofit world, we call it refundable advance, but it would be a liability. And you may either have to return that funding to the state or federal grantor, or I know the state of Connecticut is trying to be a little more user friendly in terms of allowing agencies to retain their surplus, but there are some hoops you have to jump through. So if you have unspent funding, you need to talk to your funder at the state and effectively get an okay to keep those funds. You don't get to make that decision yourself. You have to clear it with your funder.
All right.
So we could probably talk 8 hours about grants. So this was a very high level, quick presentation. But if you're a person who's doesn't have the background, if you're a for-profit background, for example, we're going to be sharing, or the Alliance will share the slide deck. So feel free to use that as a resource. We included the links in there. And then also Tom and I are happy to talk with you. You don't have to be a client. We're happy to have a call or, just give some advice if we can be of service.
All right.
Well, thank you all so much. Thank you to Tom and Katrina for all the wonderful information today. And thank you to all of you who joined us. You will be getting an email from me by the end of the week with the recording and the slide deck. And if you have colleagues who have registered but weren't able to join us, they'll be receiving it as well. And yes, please feel free to reach out if you think of anything else, any questions for either myself or our presenters today. Otherwise, we'll see you at a future Alliance event or training. Have a great afternoon.
Thank you.
Very welcome.
Thank you.